the fact that we are estimating, it means our accounts for that year is still incomplete. Not only businesses that are new that are making incomplete records, other businesses too can also make what an incomplete record. And how does this happen? It happens when we are estimating our financial statements. So when we talk about our financial statement, we're talking about our trading profit and loss account, or the statement of financial position. So how do we estimate and what makes it to become an incomplete record? It becomes an incomplete record when we are thinking about markup and margin. When you talk about markup is a percentage of the gross profit and sales, the percentage of your gross profit and the cost of sales. And margin is the percentage of your gross profit and revenue. So for markup, it means you are thinking more of an increase in the percentage. For margin, you are thinking more of reduction in the percentage. Do we get it here? For markup, it is an increase in the percentage of your gross profit and your cost of sales. For margin, it is an increase in based on what? The gross profit and revenue. How do we get our gross profit? Remember, our gross profit is what? Gross profit is cost of sales. Cost of sales. Sales minus cost of sales. This is how we get gross profit, right? Do we still remember that place in the profit or loss account? Then when we talk about revenue, revenue is just the amount of money we make in the cost of selling. That's the amount of money we make. So if we have to use a markup as a business, what do? We use the formula gross profit divided by the cost of sales multiplied by 100. Whatever we are given, let's assume that business ABC Limited is using a markup of 40%. Sorry. Let's say ABC Limited is using a markup of 40% on revenue. On revenue, let's say on revenue. What does this imply? It means that our revenue will be 100 plus 40%. So this is what our revenue will be based on. That is markup. But if ABC Limited is using a margin of the same amount of 40%, of this 40%, it will mean 100 minus 40%. Do we get the difference here? For markup, it will be 140 multiplied by that amount value of revenue. For margin, it will be 100 minus 40, which is 60 over 100 multiplied by the value of the revenue. Any question about that?
I didn't understand.
Where? Markup or margin?
Both of them.
We have, okay, let's say we have the value of our revenue to be 800,000. This is the value of our revenue. Okay? If this is the value of our revenue, we're using markup on revenue. If we are using markup on revenue, it means 100 plus 40%.
How are you using markup on revenue?
Yes, it's a prediction. You are estimating what your revenue will be. That's why we call it markup. You are estimating what your revenue will be. Do you get the point? It's an estimate. You are predicting that, our revenue should increase by 40% this year.
Yes.
Do you get it? Our revenue should increase by 40%. If you are thinking about that, it means markup. Revenue might decrease by 40% this year. It means margin. The margin between last year figure and this year, that's margin. That means there's a gap. But markup means there's an increment. Do we get it now? So let's assume not really okay. I'm going to explain.
If you understand what you don't get,
I will. But what they are saying is this. Let's assume our revenue is 800,000 for this year. So we are predicting that the next year our revenue should give us a markup of 40%.
how?
We are predicting, we are thinking, we are estimating, we are speculating 40% that our revenue will increase by 40% next year. That is markup.
Yes.
That means whenever we have to base our gross profit, we're going to base our gross profit, our cost of sales, and the revenue on 140. So it means our gross profit will increase by 40%, our revenue will increase by 100%. This is what I'm saying. This is 800, but we said we predicted that our revenue will increase by 40%. 40% for 800,000 now. This year our revenue is 800,000. We predicted that it's going to increase by 40%. What does that imply? It implies that our gross profit would have increased, our revenue would have increased. So the total will be what? 140%. This is what it's going to be. Because we are thinking about market. So how do we share this figure of 140? It will mean that our revenue will be 140% of this. Our gross profit will be 40%, and our cost of sales will be 100%.
Why 100%?
That is the amount of money we're going to spend.
Why?
Yeah, because we said we are predicting that we're going to have an increase in revenue for 40%.
No, Mr. Answer the work exam.
Yeah, we're going to do that.
Work exam.
Yeah, sure. It's done already. It's just an explanation.
Like Mr. Wait. 180,000 divided by 150,000.
When you take this away from this, you get 450,000.
What?
When you take 630 from 180, you get 450,000.
630.
Yeah.
Revenue minus gross profit, which is cost.
Just listen. Sit down to get it. There are two things we need to know here. For our markup, we have 100%. They said our markup, we are having a markup of 40% in our revenue. Without revenue, we can't talk about profit. Yes or no? Without revenue, we cannot talk about the gross profit. So if we're going to have 140 in terms of our revenue, we will not just make the 140. It will be the combination of our cost of sales and revenue. We cannot increase our revenue without increasing our cost. Do you get it?
Yes.
We cannot increase revenue without increasing the cost, without incurring costs. You would incur cost. You can't just make money without spending or investing too. Sit down, please. That is why we have our cost of sales. So here, if we're going to have a markup of 800,000 revenue, it will mean that we're going to have our gross profit of 40% and our cost of sales of 100%. That gives us 140%. So what you have to put in your mind is that whenever we talk about markup, is an increment in the percentage of the cost of sales and the gross profits. And when we talk about the margin, it means a reduction or a decrease in the gross profit and the revenue as a percentage. Is this still difficult or not?
No.
Yes, we have markup. Markup means we are thinking of an increase in what we are going to sell for the next year. We are thinking of an increase. That is markup. That means there is always 100% that we have to add on to. So we are thinking of a markup of 40%. A markup of 40% means our business would have increased its sales by 140%. If it's going to be a margin, it might be because of economic situation. Oh, we might be thinking of a fall in revenue this year. If you are thinking about a fall in revenue this year, that means there's going to be a margin in what we made last year and what we are going to make this year. There's going to be a margin, there's going to be a gap in what we made last year and what we are making this year. Then we are thinking of reduction. Reduction means what? Decrease in the percentage. So instead of saying 100 plus 40%, we're going to say 100 minus 40%. Do we get it now, clearly, please? So markup is 140%. Margin is 60% because it is 100%. It is 100 plus 40 markup. 100 minus 40 margin.